the law. So first is refundable employee retention credit, 50% of wages paid up to $10,000 per employee from March 13 to December 31, 2020. Now that is very, very good. That means you pay yourself. So now many of you are S Corp or C Corp, but a small business. And if you haven't really paid your salaries, I think it's a good opportunity to pay yourself some salary quickly. Okay, before December 30, let's pay yourself, at least pay yourself $10,000. And then, the government will pay you $5,000. Okay, so that you made $5,000 just by paying yourself $10,000. Okay, and then if you're S Corp, you have to pay yourself something anyway, reasonable salary anyway, so that you don't have to pay self-employment tax. Okay, so take advantage of that. Now this is a double sweet. It's refundable. Refundable means, usually tax credit is not refundable. It means that you can only offset the tax you have to pay. But refundable means even if you do not have tax to pay, they'll give you the money. Okay, they'll deposit money into your bank. Okay, so that's really, really good. So highly, highly recommend you to take advantage of it. Okay, all your, S Corp or C Corp people, do that. And then credit for sick and family leave, 80 hours at normal pay. And then also this is also for your employees, it's the same. You can do that. So your employees very happy. You pay them, retain them rather than fire them. Pay them and have them do some work because $5,000 is paid by the government. And then credit for sick and family leave, 80 hours at normal pay, up to $511 a day. So this, you can use it for yourself if you have, if you get sick and you leave, good. But it also can apply for you to leave and take care of your family, okay? And this is for per employee, okay? So this is per employee. Every employee gets up to $5,000, okay? And then care for child. So because of this pandemic, those kids have to stay home, and then parents have to leave work and take care of the kids. So if you are in that kind of situation, you can get $10,000 for taking care of the kids. Okay, that's also very good. And then the economic injury disaster loan. Now, many of you, if you have a payroll, you apply to the PPP and you got the PPP, and then you most likely will get forgiven because you used it for payroll and mortgage, lease, etc. Now, on the other hand, if you don't have payroll, you probably apply to the EIDL. Now, the good thing is the EIDL can be forgiven too, right? So at this moment, it says 3.75% and 30 years. But and some people ask me, should I pay it off? No, do not pay it off. Even if you have to pay it off, the interest rate is so low and the term is so long, it's cheap money. You can use it, really use it for your business. It's good time to invest in your business, use the money. But on the other hand, if you can document that you used this money for payroll, and it could be paying yourself, right? For business purposes, for lease, for mortgage, for developing a software or platform, whatever, for even just, the rule is very generous. Other payments that you need help due to revenue loss, right? So really, almost all expenses for a business can be qualified for forgiveness. So it's really important that you document these, and then later on I'll say how important it is to have your story and have your book clean. So when you apply for the forgiveness, here is the information. And if the story looks good, they will not audit you. But if the story, if there's something jump out, looks odd, they ask your documents, and then you have the documents already ready to give them. And then also this one is also good, deferral on payroll tax payment in 2 years. Okay, so again, a good reason for you to pay yourself and pay your employees with payroll, because the payroll tax you don't have to pay until next year. Okay, so this year when you do payroll to pay for yourself and for other people, you know, and even better, you pay yourself more and you defer. If you're afraid of paying income tax, you know, defer to your 401k, and then, you know, you can borrow the money from your 401k, still use the cash. But the good thing here is that you do not have to pay payroll tax. Isn't this great? You know, 15% of that. So you pay yourself $10,000, you don't have to pay $1,500 payroll tax. So that's, again, basically the IRS is lending you money for your business development. Okay, so you pay 50% on December 31, 2021, and 50% on December 31, 2020. Another thing, you do there's no 10% penalty on distribution up to $100,000 from IRA, and you can spread the tax over 3 years. That's also very good. You can borrow the money out and invest in a business, or you know, use it for down payment for house, or probably roll over to a Roth IRA. You know, so I think that's also a good policy. And then charitable deduction. Charitable deduction up to, because usually charitable deduction is up to 60% of AGI, but now it's 100% of AGI. Now this applies to, we can use charitable deduction strategies, and this especially if your this year's income is very high, or previous year's income is very high, and later on I'll talk about how you take advantage of the carry forward and carry backward. So this is if your income, I would say, more than $200,000. Josh, what do you think? You know, if your total income is more than $200,000, we should explore that to reduce the tax or get rid of the tax completely.
Yeah, that's about right.
Okay, let's see.
Hit the escape button. There you go.
Yeah. So net operation loss from 2018, 2019, and 2020 can carry back 5 years. So basically, the 2017 Tax Act says net operation loss you can carry forward for 20 years, but you cannot carry backward. Now this says not net operation loss from these 3 years can carry back 5 years. Okay, so that creates some opportunity. So if you have 2018, 2019, 2020 net operation loss, well, we probably can go back and amend your previous 5 years, you know, 2013 forward, 13, 14, 15, 16, 17. If these years you have profit, right? We can go back and amend these tax returns and then get tax refund. Okay. Now, that does not mean you have to have a C Corp or S Corp. Even if it's Schedule C, we can still amend that. We can still ask for the net operating loss. Okay. We can just put on the for the individual, you know, 1040 on Schedule 1, line 8, I think, other income. We can just say net operation loss carry back. Okay, and then we can write notes. You know, these are from 2018, how much from 2019, or from how much from 2020, and then we can still get this money back. Okay, and then the beauty is we can fill a form 1045 and ask for refund right away. We don't have to wait until we file 2019 or 28 tax return. Okay. Now this one is not net operation loss can carry over to offset 100% of income for 2018, 2019, and 2020. So originally the rule is you can only offset 80% of income. So if you have $100,000 income this year and you have $100,000 net operation loss carry forward, you can only offset $80,000. You still have to pay tax based on the $20,000. But now you can offset 100% of the income. Okay, so that's also good news. That means if you have a net operation loss, say from previous years, you can carry forward. You can carry forward to 2018, 2019, 2020, and we can make an amendment for these tax years to reduce your taxable income and get a refund. Okay, if you have previous year losses, okay, that you haven't used it yet. Okay, and then I do not see in the law says how many years before you can find. So I think whatever the losses that you can find, right, reasonable time. I know the statute of limitation is 3 years. So, but at least I think we can go back to 3 years of losses, before 2018, and then just carry forward to offset that. So these are things you can apply to your situation. Think about your situation. If any of these apply to you, then we can do an amendment and get some money back. Okay, any questions so far? Any comments?
So I have a question.
Mm-hmm.
For example, there's a property tax 2019, 2020. So that deferral property tax. So usually there's a 10% penalty. Yeah, is that right?
What's the 10% penalty?
It's a deferral property tax.
Well, property tax, if you're talking about property tax, usually you're talking about, there are two situations. One is if it's a rental property, then it becomes a business income or loss. And usually rental property, because of depreciation, plus the tax and the interest, usually it's a loss that you can use it to carry forward or carry back to offset your income. Another context when you're talking about the property tax is probably your primary resident.
Yeah.
If it's primary resident, then you're itemizing it. Okay, so the itemized deductions, you have to put it in there. Now this does not relate to carry back or carry forward. It's not net operating loss. Okay, this every year you have to just deal with this every year. And if you miss it, then you miss it. Okay, and then there's for tax. I know interest. There's no limit. Interest, up to $1 million mortgage interest. Now the tax. I think the tax is if the tax is in the interest section, I think it's in the interest section. So there's no limit also. So you can itemize it. Itemized deduction.
This is Anna. I have a question as well, if I may.
Sure, Anna.
So what if you receive both, the PP loan and the EIDL are both forgivable?
Okay, if you got both of them, right? First, congratulations, you got both of them. So the PPP for sure, it's a first priority, first, forgiven. Now, the EIDL, I would prepare to apply at least. And in your case, I think you have a compelling case. Most of the expenses are all for business, to maintain your business, to maintain your employees, right? The spirit of the law is that you use the money to uphold the economy. keeping the employees, all of these. So in your case, Anna, I would highly recommend let's prepare to apply for the forgiveness for the EIDL.
Okay.
Yeah, let's apply all of these. Yeah. And if we lose, that's fine. We lose, but at least we should try. Any other question? Okay, so with no question, some of you have gone through this, but every time you go through, you have something more like aha moment. So newspaper is better than a magazine. The seashore is better than street. Even children can enjoy it. Birds seldom get too close. Rain, however, soaks in very fast. One needs lots of room. How do you feel? What are you getting? You're saying like, Jinhong, why are you talking about these? I came to learn tax, right? I'm confused. Now let's read. Kite. Newspaper is better than a magazine. The seashore is better than on the street. Children can enjoy it. Birds seldom get too close. Rain, however, soaks in very fast. One needs a lot of room. Kite. You're talking about kite. I get that. It makes sense. So what I mean is the context is important, right? So when Ray was asking me about the tax, property tax, well, what's the context? Are we talking about the rental property? That's net operation loss. Are we talking about the primary residency? That's itemized deduction, right? The context is important. The story is important. The story is a context. So later on, I will talk about, everything. A lot is about context. And when we analyze Joe Biden's tax return, Bill Clinton's tax return, we will see different context, okay? And then you will relate it to your own context. So thinking context is very important. And in this case, I'm also going to build some context for us to think easily. So this is an example of a context I create to think about tax, okay? So I put these, few dimensions so that it's easy to think. So the first context is intention. So sometimes we think the government create all these tax laws to take money from us. That's a context he created. Another context is, well, the government created these tax laws to guide my behavior so that I can take care of my business, my family, my community, so the government doesn't have to, right? So I tended to believe the later context. I think the policy is really guiding us to take care of ourselves. I think it's more efficient than paying the money to the IRS and have them take care of the society. Okay. So the strategies. So really tax, later I will talk, there are only 3 strategies. All the tax laws you feel overwhelming, but if you really think from the 3 strategies, you can pull all the laws into these 3 strategies and apply to your own life, how I can use these 3 strategies to save tax. Oh, sorry, I promised people that I will record.
I'm already recording for you.
Okay, awesome. Thank you so much. So, and then structure. Structure is also context. So when we talk about medical expense, where do we fall, right? Later on, we will look at, Bill Clinton and Joe Biden's, they put into itemized deduction. Okay, then they're subject to a percentage of your AGI. But if I put into my business, right, employee benefit, well, you can deduct all of them. So the structure is important. We think about structure. And then vehicle. And for us, we really focus on these vehicles, I think it's important. Real estate is something in America, it gives you so much tax incentives that you can build wealth over time. And then business, okay, huge, so much. I think that's what makes America great. It's a very entrepreneurial society. And tax savings. Now, tax savings, you say, Jin-Hong, I can't touch tax savings. Why are you saying that it's a vehicle? But to me, tax savings is real money. You will see it. A dollar saved in tax savings, it's just the same as a dollar earned in business. So I put tax savings, although it's conceptual, but it is real money. It's real vehicle. Even just by learning tax return, tax saving, and I really want to acknowledge you guys. Take time from your busy schedule and learn tax saving strategies. It's real money. You will see it. It makes a huge difference. You know it, you plan it, or you don't do it. It's huge difference. And then if you put into the lifetime, and you also adding into the money that you paid to IRS that you otherwise could invest and earn growth, huge. We're talking about millions and millions of dollars. And if you're an entrepreneur, very productive, multiple millions of dollars over time, and it will affect your children and next generation, all of these. So it's huge, okay? We should really learn that. And then the last is content, okay? Last is content. Most of people, we made a mistake. We just learn content, and then we get overwhelmed and then say, I don't care, I'll just give this to my accountant. Well, your accountant will not know everything you do, and the stories has come from you. So it's important that you learn enough so that you can have a conversation with your accountant and you can strategize together. Okay, that's what I believe, and that's why I do this kind of education, because it has to be a partnership, but we work on this together. So there's another example of the story, right? So you could do your tax, you can put your budget like this, or little bit creative, organize in this way. So the stories start to make sense easily. So with that, I would say context is very important. Everything starts with the context. And then with the context, you create habits. And for us, I truly believe the context of really creating your future. That's why I say, some of you, if you're not an entrepreneur, and I talk about some of the entrepreneurial strategies, you may get like, it's nothing to do with me. No, it's really creating, yes, right now you may be an employee, but hey, after talking this, thinking about that, you probably say, hey, let's start a business. So it's really a habit of creation, a habit of proactively creating, planning your business and your life. And then the systems. So everything we do, we have to build it into systems so that when you apply for tax credits, etc., it's all there. It saves you time. Okay. So there's another context we talk about. I did a budget. We can't afford. Well, or you can say, yeah, well, we can't afford, but we can create it. So this is the structure. So here it's very simple. You have income minus adjustment to income, and then become adjusted gross income. And then you minus a standard deduction or itemized deduction, whichever is bigger, minus qualified business income tax income deduction. This is taxable income times the rate. This is how much you owe, and then minus tax credit and tax paid, and then this is what you get refunded. So 3 tax strategies. First, earn as much as possible that tax-exempt income. For example, life insurance proceeds, primary residency sales, right, $500,000, qualified small business stock, capital gain tax free up to 10, the greater of $10 million or 10 times your investment. And or just completely free money like America Cedar Fund, for example. Okay, so these are examples. And the second, is take advantage of all the deductions to your income, adjustment to your income, okay, such as 401k, HSA, and tax credits, okay, such as the renewable energy tax credit, R&D tax credit, all of these, okay, child tax credit, of course, applies to everybody almost. And then third but not least is you shift your tax liability to other entities or to future years. Okay, so give an example. So I say, we have a house, we pay off, and we are in the old years, retiring, and we don't have much, we're not working anymore, not much income now, and I don't have to take any itemized deduction, interest. I have no interest anymore. So what I do, I sell my property to my children. While they are earning prime salary, $200,000, now they can pay me interest, so they can take the deductions, right? Now I can still live there. I can lease it from my children, right? So now if I lease it, it's even better. They can now even take deduction for the depreciation. And then they have a rental loss against their high W-2 wages, right? That's a good example of that. Another example, say, well, my business is doing great, and I'm gonna have $1 million income this year. Well, that means I have to pay state and federal probably $300,000 tax. How can I get rid of that? Or maybe I can do something. I can buy some IP, right? Invest in something, buy some IP, and I can say, this is something. It's an investment, and I can write off tax completely. Or buy from home. Or maybe I can have a Cayman Island entity that hold the IP, and I can buy, from that. And then the money is shifted to Cayman Island, and you can invest, right? Then I can get the tax write-off. Okay, so these are examples. So here are examples of qualified small business stock we talk about. So that is actually very, very important. A client just said, well, Jinhong, I'm going to sell my business. I say, how much? $6 million. Whoa, how much did you invest? Well, I didn't invest in anything, it's just my blood for 5 years. Well, great, $6 million. You have capital gain of $6 million. Well, are you a C Corp? I said, no, I'm an S Corp. Well, it's then you limit yourself a lot. So that's what I'm talking about. Sometimes we say, okay, well, I want to do an S Corp so that I don't have to pay double tax, right? But on the other hand, if you really look at the big picture, if I'm going to sell my business in 5 years and have a big capital gain, $10 million, probably it's better to have a C Corp and pay some tax, which is little, but at the end of 5 years, hey, I can save $10 million times 20% or 30%. In California, you have the state also. We are talking about $3 million savings, right? So plus people ask me, okay, but the C Corp, you're paying double tax. Well, here's the thing. If you have a strategy to make money by the capital gain, really in these years, you try to build up your value. So instead of giving yourself dividend, don't do that. Don't do dividends. We just invest the money into the business. Okay, make the business loss or just no income. Okay, just like what Amazon did. Just invest in your IP. pay yourself enough salary to live on and defer as much as possible into 401k, and then put all the money into the business to build up your IP, build up the value, right? So you don't have to waste these tax on the yearly income tax. So at the end of the 5 years, you sell it, you make the good money, okay? So you have to be, 5 years, okay? So the capital gain tax exemption is on the greater of $10 million or 10 times adjusted basis. Most of the times, the startup, we didn't put much, And if we put $100,000 in there, it's only $1 million. So most likely, we're going to take this number. When we sell it, maybe it's $20 million. So $10 million, you don't have to pay tax. Okay, you save $3 million right away. This is really, really good. America Seed Fund, I really, really am very passionate about. If you have some good inventions that is original, okay? And a lot of times original, right? You really think a little bit, you integrate something, you improve something, you partner with somebody that people haven't done it. There's very high possibility that you can win that. And so the first stage, you get $256,000 for R&D, and then second stage really, help you to scale and produce. And then the third stage, when you start to raise money from private companies or you start to generate revenues, they will match 50 cents to each dollar, okay? So this is something really, really good, okay? If you are a technology person and have some good idea, have some good technology, talk to me, okay? And if you started a business already and you want to really, innovate, talk to me. Let's apply that. Let's apply that.
Jin Hong, quick question.
Yes.
So would we qualify for something like this?
Yeah, I have been talking to you about that, and you said it has to be original. Let's sit down and really think about it. We can make it original.
So I kind of looked into it a little in more detail, probably last month. And it looks like it just needs to be part of that existing project, has to be original. And we're going to get a patent for something like that. We've already applied and we got it. So it's just going to be issued soon. So let's talk about that piece.
You can always improve something, or use.
Yeah, that's what it is.
In your case, Sanjay, you've built a foundation already, and you can apply it in so many other cases, right? And each application, you have to improve something or add something new into it, right?
Yes, those are the things I want to talk about. Okay.
Yeah, I just have a client. He just got the approval for the first pitch, and he has just bold vision, and people they like that. They keep pushing him, saying, okay, this is not bold enough. How about this? How about this? And he just keep pushing. He keeps just adding it. And he's not a technical person. He doesn't know how to do it. But he sees the vision. He keep creating it, and they approved the sales pitch now. And now we're just writing the story and building the team, right? So this is not too hard to get it. If we really put our minds in there, the chance is pretty high, and it's worth it because the money is very high.
Okay.
And the good thing is, Sanjay, this is a validation. Once you get this, it's much easier for you to get venture capital. You can really much play bigger, right? Mm-hmm. So it's worth the time if we commit ourselves and work on it. It's really worth it. Okay. So this is another example of a no tax-free income. So if you invest in real estate, right, you do a 1031 exchange, and you just exchange up again. So like this one, if you have $500,000 capital gain tax, if you don't do the 1031 exchange, you're paying $140,000 tax. You know, the leftover you invest, you get about $10,000 a year return. Otherwise, you know, $500,000 you invest into a new property, and then it's your annually is $40,000. So, you know, every cycle, you know, I would say every cycle, real estate has cycles, every cycle, you know, about 16, 20 years a cycle. Every cycle you sell one, you do an exchange, right? In your lifetime, you exchange 2-3 times, you build up a nice retirement income already. And then you pass on to your children. Your children now, you know, become a capitalist rather than, you know, have to struggle like what we do the first generation, right? So it's a very simple strategy that we can accomplish. And that you don't have to be a business person, you know, that even if you have a W-2 income, as long as you are stable, you know, you can get a loan and buy property. So there's an example of how you take advantage of adjustments as much as possible. Okay, so this is an, say, S Corp, husband and wife, you know, pay themselves a reasonable salary, and then the K1 is $1 million. So you got a $1.2 million income. Now you have to pay $500,000 tax. The leftover is $7 million. Now if we just do a little bit, you know, put some 401k in there, and you know, and then we create a cash balance, aggregate benefit, profit sharing program. We put money, defer this money in there. Remember, if you need cash, you can borrow them out, okay? And then here, you know, we have very innovative ways most people don't know. We can include something called a 401h. 401h is like 401k, but H stands for health. So when you retire, you can use money for your health, okay? Now think about what is not related to your health, right? Travel to Hawaii, do massage. Are they good for your health? So you get the point. So you really, your taxable income is only, you know, $180,000. And even just use this money, you know, you probably can live pretty well. But you saved $500,000 tax. Okay, all of these money now is all yourself. And when you retire, you know, you enjoy the money. And also you can pass on to your children. Okay, this one, everybody should take. So here, this is one, and later on when I talk about Bill Clinton's tax return, you will see it like a wall. So if you have a small business are generating more than $50,000 net income, you should have an S Corp. And now C Corp and S Corp, this is the difference. So if it's an S Corp, so you have 20% qualified business deduction. So this is a sweetener by Donald Trump. So really your income tax, you know, it's say 19%. Now if it's a C Corp, you just pay 21%. Now, if you do dividends, you have to pay again, so it's higher. But on the other hand, if you have a C Corp, don't think about paying dividends. Just pay 21% and call it a day. And then really your money is made when you exit, okay? And exit also does not mean you have to fully exit. You can sell certain stocks, right? Whether through strategic acquisition or through IPO. Now, if you have a rental property, you have you know, anything related to real estate, we will do a cost segregation, and we will expand more. And especially in this day, you know, we take advantage of the net operation loss carry back and carry forward in these years, especially 2020. You know, take advantage of that. So if you have rental properties, talk to me. Okay, or you have any commercial properties, real estate, talk to me. We should take advantage of this and take advantage of net operation loss carry forward backward this year and get some money back. This one I'm not going to talk about. Most people, so qualified opportunity zone fund. If you have money that you you can invest in these qualified opportunity zone fund for more than 10 years, the capital gain tax is free. You don't have to pay capital gain. So here, this one I'm advocating for entrepreneurs. If you're raising money, set an office in one of these opportunity zone funds and raise money saying that we are a qualified opportunity zone fund business, okay? Now that will give the investors a good incentive. They will, save some good money. And the incentive are big. It's like $100,000 in 10 years. They save $700,000, and they're everywhere in Los Angeles. You don't have to go far away. And then the ESOP is also a great idea. I really love it. It's not only a good retirement plan, but also a financing plan. So it's almost like a mini IPO. You can use the ESOP to borrow money, right? You're leveraging it. So that's very important. And it's also a good succession plan. You can identify some good employee and eventually, they can buy your shares. So with all that said, first, I think I should pause for now and ask questions. We've talked so much. So any questions? Any comments? Anything you see us relate to yourself?
So the employee stock, what was the previous slide again? Can you go back to the previous one? Employee stock ownership plan. So how does this work again? So if I have employees and they have stock ownership, so they can shelter that. What if it's like a safe, and then it matures after every year 25%. In 4 years they're fully vested. Then what happens? Can they put in some kind of a stack? So
the safe is a safe. The employee tax, the ESOP is like a 401k. You have to create it. It's a tax shelter. So you have to create it as a plan. And then the ESOP now is like a trust, an ESOP trust that can borrow money from the bank to buy your stock. If you think this way, this is almost like you're doing financing from a venture capital, right? Also, it's like just borrowing money from the bank. So that's why it's a financing source. It's a tax shelter because it's like 401k. You can put money in there and take the tax deduction.
Are there anything, do you need to go through some basic stuff to qualify for something like this, or anybody can just do it?
A specialist they have to set up for you. Usually, Sanjay, I think in your case, probably 1 or 2 years down the road when you have, 5, 10 employees.
Okay.
And
I'm just trying to understand it. Right?
Yeah. I think at that time, we'll spend $40,000.
That's what I thought. Yeah. There's some.
Put the things together, and then we can, also get financing. And at that time, you scale a business. I think that's where we will be.
Okay. No, I'm just trying to understand it. Right?
Yeah, it's good. But it's really good. I really love this. It creates a culture. The research says, the ESOP companies are more productive because it creates a culture of ownership.
Yeah.
Any other questions? So here, remember we talked about the context, the habits, and the system. So everything we do, we need to create a system. Because if we don't have systems, we're going to be chaotic. And then at the end of the year, we're trying to put the numbers together to apply. That's too late. If we have systems, even before the end of the year, like this time, we see, okay, how much we might qualify for the R&D tax credit next year. Okay, how much we might, have to pay tax, and how much we should put into 401k, or do I need to have a 401k? All of these are important. So the systems you put into a system. So you design the system, what do I need? Okay, and develop some key financial statements and really come back to the original, the story. How can you make, when you develop your financials, make it easy for you to understand using your own language, okay? And then make it simple so that it's easier for you to understand it. And then establish solid financial and accounting foundations, which in the technical term, mainly is the chart of account, the accounting system. And then you build up from the bottom, like engineering, you really build a house from the foundation, which is chart of account, your system, you put the system together, use the chart of account, and then you develop a budget based on the same chart of account so that you enter these budget to the accounting system, and then you can print the budget to actual reports. And then when you grow a little bit, you can empower your managers to make decisions based on the budget to actual. If you have money there, you just make a decision. You don't have to sign every check. And then you develop the financial statements, and then you have what you need to understand your business and have insight. And there are a lot of models to create your story, right? This is a model I like. It's called the exponential growth model by Salim Ismail by the Singularity University. So you can create a business based on this model. First, you have a massive transformative purpose, and then on the left side, you have the structures, like Uber, you have the interface, and then the left side, you have the engagement for all kind of the society can engage. So you can build your business, you can build your chart of account based on this story, right? These segments, and you can watch, are you taking advantage of this model? Salim says, if you are taking 3 of these models, 3 of these aspects, you are most likely going to be an exponential organization, will grow exponentially, right? And this one is a model of a value stream. It's really the Toyota way, the lean management. Interestingly, every business, there are 4 categories. And then there are always about 19 to 21 activities that you can keep track of it for the entire value stream. And then you will look at the numbers. And if we build a system like that, you look at your numbers, look at the percentages, and you think about it. Oh, why is the reason? So the 4 categories, marketing and prospect, and then customer acquisition, basic sales, and then customer delivery system. So it's basically your service or production, and then the back office, all of these. And by doing that, you have look at these numbers. So like recently, I have a client. They have a big number of R&D tax credits. R&D tax, R&D expenses with all the payroll, but their revenue is low. And then I look at the marketing activity. Marketing is only like $6,000. It's like, whoa, it's like, that's missing point. So now it's time to hire marketing people and then, focus on that. So that gives you a way to manage it. So really, you want to, if your business gets complex, you want to think about how you manage it. And you can use 3 dimensions. One is, different businesses, right? And one is you can look at the different projects. And then when you're doing the R&D tax credit, they ask you what project, what research, it's easy to keep track of these information, right? And then, the reports also, you can, these are examples of nonprofits that you can print. So with that, before I go to the next step, what questions do we have? Or comments? Okay, so remember we talked about the second strategy is to take advantage of adjustment to income and tax credit. So one major tax credit is the R&D tax credit. And this one, especially for technology related companies, it's really good that the government is helping you. So we'll quickly talk about. So basically, the purpose of this law is to encourage innovation in business, and mainly domestic business. However, the original law only applies for big companies because you can only use the tax credit to offset your income tax. However, the small businesses are the drive for innovation, and the small business usually don't have income until say 4 or 5 years later. So in December 18, 2015, Obama signed a law called Protecting Americans from Tax Hikes. So now startups can offset payroll tax. So, and then this is permanently extended. Okay, this is going to be there no matter who becomes the president. It's always going to be there, and it also clarifies the definition of qualified research, and then also added different expenses like if you subscribe for SaaS or software, it's all qualified. So the startup, if your revenue is less than $5 million in the last 5 years, you qualify. Now, this can be flexible, right? A lot of times, sometimes, like you have $5 million and $100. Well, then you don't qualify. Well, again, come back to the story. Do you have to report $5 million and $100,000? Right? There's not so many ways you can move it to below $5 million, right? And then you start revenue 5 years, within the 5 years. So that's where you can offset your payroll tax. But if you are more than $5 million, you can still use it to offset your income tax. And then the good thing is California is also have the same R&D tax credit, and it's very generous. So if you use it for permanent purpose to improve the function, performance, reliability, or quality of your product, and also to eliminate some uncertainty, and it takes a trial and error method, and it's technology in nature. You can qualify for that. And how much can you qualify? So for the W-2, box 1, 100%. For contracting, independent contractor, 65%. But it has to be in the US. And then supplies, including software, you can qualify 100%. And then think about this as about 10% of your qualified research expense. So if you spend $100,000, you qualify for $10,000. If you spend $1 million, you qualify for $100,000. Any questions so far? Okay, no questions. I will talk about our process. Our process, the way you work with us, we have first, we spend quite some time in the beginning. We believe in proactive and developing system and thinking strategically. We usually think when we build a system, we stand at 3 years from now, okay? And then, after 3 years, we probably needed to review and look again. So onboarding and planning, and then we implement the system. So the onboarding planning usually include designing the system. And then we will have review meetings in the beginning, maybe monthly, and then quarterly and yearly. And then we file tax returns. This is just an example. So all kinds of tax returns we file, and then we claim credit. In this case, if it's a R&D tax credit, we claim it on the payroll. So are we a good fit? If you want to hire us, this is who we are. We are 100% technology driven. We are 100% virtual. Okay, we meet online, and when we meet offline, really it's meet to celebrate. You know, it's kind of just more for the human part of it. But most of the work, it's all done through Zoom meeting. Okay, and we use technology to the fullest. We automate everything. We use QuickBooks Online, we use Bill.com, and the QuickBooks Online, we will work with you and set up rules to automate as much as possible the bookkeeping, okay? And then we're affordable, okay? We are affordable. Our goal is to automate all the routine transactions so that we have time to look at the numbers and to look at your strategic plans and plan together, and have insights, create a value for you. That's our goal. And really, it's a partnership. So that's why we do trainings like this. At least in this November, I'll do one, and then usually, about March, I'll do another one. Usually, like a group like that. And then, of course, you can always book time on my website, and we can talk whatever situations you are. And we charge monthly so that we encourage you to feel comfortable to just make appointment with us rather than worrying about how much I have to pay per hour. So we usually have fixed fee, monthly fees. And then also we do not charge additional fee when we file tax return at the year end, because we want to do it proactively, okay? So the work is done in the year, during the year. That's important, okay? That's how we do it. And so we use, we'll debit your money from your account automatically. So if you work with us, we just automate as much as possible, okay? And then we always document and secure everything. So that's what we do. We are documenting everything as if we will be audited. Okay. Now, by doing that, my case is we've never been audited because we think it through and we have created a story that makes sense. And in tax, tell you the truth, it's just the story. The story makes sense, no problem. And if they have a question, they send a letter and we have a reply. We already have documents, okay? Everything's there. So that's the way we do it. Any questions? So if you want to talk to me, make appointment on my website, just go there and click schedule now. That's the best way.
What's your website?
So it's hzcpas.com.
Great.
hzcpas.com.
Thank you very much, Jinhong. That was very insightful.
Thank you. Are you guys interested to look at the Joe Biden or Bill Clinton's tax returns?
Sure.
Let's look.
Why not?
That sounds interesting.
The daredevils are still with us.
So this one is Bill Clinton's. So this is Bill Clinton and Hillary. This 2014 when she was running for president. So if you look at this, okay, wages $93.
Okay.
Okay. Business income loss. Schedule C. $28 million. Schedule C. Whoa. That means she has to pay 15% of self-employment tax because she does not even pay. See, if you would have a C Corp, you would pay yourself some wages, right? Apparently, she didn't do that. Okay, so this 28 million times 15%. Okay, that's your self-employment tax. Of course, that's roughly, but there's a limit for my FICA, you know, etc. But there's a lot of sales. There will be a lot of self-employment tax. Okay, so now, indeed, we see self-employment tax. Half of the $300,000. So she's paying, you know, $700,000 self-employment tax. So I think that's a big problem with this, and I don't know how, you know, he found his accountant that his accountant doesn't advise him to start at least an S Corp. Okay, so yeah, he does have a lot of itemized deductions, and that's good. So he's, you know, his taxes are almost $10 million, and he paid $10 million estimated tax. And so he overpaid $600,000. He borrowed the money to the IRS, interest free, right? So that's also a bad estimation, right? You should, if you have a proactive accounting system, you see where you are, and your estimation should be quite accurate. You wouldn't pay this much extra estimated tax. Itemized deduction, you know, these are the state. Now, this year, these things, you don't have it. Okay, real estate tax, okay. So, Ray, to correct, the real estate tax is actually within the tax you paid within here. So you're subject to the $10,000 limit now, okay? And when we look at the Biden's 2019 tax, we'll see more. So the interest, you get deduction, good. Now he has a foundation. He contributed a lot of money to the foundation. Okay, that's saved that he has more adjustment to his income. Okay. So profit loss, look, he has Schedule C. Hillary is an author. She has a Schedule C for her business. And Bill has a Schedule C for speaking. He paid commission to other people. He didn't pay himself any salary or anything. Well, Schedule C, you don't pay yourself salary, but I think it's a mistake not to do S Corp. And then he has another Schedule C. So I think all of the Schedule C can be put into your S Corp. Just set one S Corp and then put husband and wife. So all Schedule C into the S Corp. I think they will save at least $500,000 self-employment tax. I think pay yourself reasonable salary. Yeah. So and here there's another Schedule C. Look. See all these Schedule Cs. We can put all of these into an S Corp. Or in this case, you know, because the amount is so big, you can just do a C Corp and pay 21%. And then you set up a 401k, everything within the C Corp and pay yourself salaries. That's also a good choice. So this is, let's look at the Joe's. So this is Joe Biden's Joe Biden's 2019. He has wages, okay, and on his Schedule A, he has $200,000. So this looks like a S Corp. So, and then let's see, does he have self-employment tax? I don't see self-employment tax. Yeah. So I think at least he did right on this way. So we can look at his, so here, so the S Corp generated $200,000 K1 profit. So the itemized deduction, that's what I'm talking about. So you have the tax, no matter how much tax you pay, state and local. So real estate tax, property tax is within the tax. So rate, so this, all of these add up. You can only deduct $10,000. You can only do $10,000 on this part. So if it's a rental property, then there's no subject to this $10,000 limit. You can deduct all the tax, real estate tax, and the interest and the plus depreciation, okay, on Schedule E. So interest, you can deduct all of them, and then charity. Okay. So here is an example. I think I can look at his previous years. He actually have medical expenses. Here's an example that I was talking about where you put your medical expense, right? So let me show you his previous years. See, previous years, he had a medical expense. He had a medical expense, $11,000, right? Now, you can only deduct what's more than 7.5% of your AGI. So $11,000, you don't take any deduction here. So, but if you put it into your business, you deduct all of them from the business, right? So that's what I mean by the context that's important, where you put the money. And then again, like the real estate taxes, your primary residence, real estate, you really can't deduct much. In this case, it's only $10,000 plus all the other state tax, right? If I were Joe, I would move out of Delaware. I'll go to, a no income tax place. I think the tax has on Nevada or something. You save a lot of money. Good. Any questions? Comments? Anything related to yourself?
That was pretty neat. Thanks for sharing that.
Thank you.
Well, they should have called you so that you can help them audit theirs.
Yeah. So
that's definitely an eye opener here to look at this, because it gives ideas to make sure that if you're able to look at this on a monthly basis, then you can kind of guide us a little bit better on what are we missing in terms to credits and so forth that we don't know. So that's a neat idea.
Exactly. So, and you're already my client. I highly recommend you to just go to my website and block times, like every month, like the fourth week, Friday, what time, right? Just block there, and you don't have to block all the time. You just tell me, and I'll set up recurring meetings, like every month, anything, like that.
Sounds good.
Yeah, so we should make it a habit, because otherwise all the priority will come and we'll forget. But it's worth to look into that and plan it monthly, or quarterly at least.
Will do.
Yeah, thank you. Hey, Alma also joined. Hello.
Hi, John. Yeah, I do actually have a question. So you were talking about perhaps pulling money out of the EIDL loan, the EIDL loan, and possibly investing it. Would that be investing it into the business or investing it into a property?
Here's the thing. When we try to apply for forgiveness for the ideal loan as well. So you don't want to put the money and directly invest in stock or buy real estate. So at least go through some procedures, right? So the way you would do it is the money should go to your business account, and then you pay yourself a nice salary, and then you can, if you're worrying about a higher salary and paying high income, put it into your 401k, maximize your 401k, $56,000, and then you borrow the money from your 401k, and now you can go buy real estate or whatever you want to, right? This way, you're using the money for your business. You're paying salary, paying salary to employees, right? Which yourself is one of them. You see that? That's the story.
Yeah.
The story.
Got it. So then that you said the 401k has a max of $56,000 a year.
I think this every year changes. Is it Josh, help me? Is this $56,000 this year?
Yep, $56,000 total.
Yeah.
Mm-hmm.
And how do you go about depositing that to your 401k? Do you do that through your payroll company? Like, for instance, we use Paychex. So would we say, hey, we're going to pay ourselves a big, large salary, but make sure to deposit that in 401k, or how is that done?
We will streamline everything. Once we set up a 401k, we will set up everything. We will have your payroll company do direct deposit. Basically, they will.
Are there other employees in the business?
Yeah, they have.
Yeah, so you can't just deposit that amount into through payroll. In order for you as a business owner to receive that total contribution, you'd need to set up some kind of profit sharing component as well in the Paychex plan. So that would need to be reviewed and properly designed to make that work well for you. Jin Hong has a team.
Josh is my 401k specialist. So if we need to set up
yeah, that makes sense, because we did set up the 401k for the company, and then at the end of the year, I received this check back from the 401k saying, hey, you placed more money there than the rest of your staff, and so here you go. And I'm like, oh, great.
You probably don't have a match in it, do you?
No.
Yeah, you're limited to what you can contribute. You should be able to contribute up to $19,500 per year through wages. But if you don't have a match, then you're limited to what the average is of all your other employees. So if they're contributing very low percentages, that limits you. But there's ways to expand that. So Jin Hong and I can talk to you more about that.
Okay, something. Yeah, thanks.
Yeah, can you?
And I'm interested in that portion too.
Yeah, Josh, why don't you type your contact, your phone number, so they can call you?
Yep. I just typed it in the chat.
Okay. That's easy.
Oh, you can just book time with Josh. Awesome. Josh is smart in all these ways.
I'm learning from Jin Hong.
I do have a question. So, for example, I got the PP loan and the EIDL loan. However, I already went through all of the PP funds really quickly. The EIDL loan, due to the situation, I need to expand. So I already have the site ready to go. Permits are taking a little longer than expected, but hopefully pretty soon. Then the expansion site will work due to the fact that I cannot have the same amount of children I had before. So I need to expand in order to make it back to where I was before. So the idle loan, am I going to be able to use it for this expansion to get back to where I was pre-COVID?
Yeah, I don't see why not. It's all business related.
Okay,
Yeah.
but is there a time frame that it needs to be spent by?
I don't remember seeing that. Josh, do you remember?
The question was, is there a time in which you have to spend the EIDL money or the PPP?
Correct.
Yeah.
No, there's
I
no.
only remember PPP is like 8 weeks after you get the money, right? But
Yeah, the EIDL is at your leisure.
Yeah, I didn't. Yeah, EIDL, there's no limit.
So the PPP loan, that one gave you 2 choices, right? You have 2 options for that. It was either the 8 or the
I think it's 24, either 8 or 24.
right?
Oh, they extended it. I think they
Yeah.
extended it.
Yes. And then for the idle, I think so far the only forgivable amount was going to be that $10,000 grant. I think everything else, as far as I know.
So there's a flexible, there's an update on that. So the 10,000, sure, that's your money. But for the rest of it, there's a possibility that you can apply. So you can justify, as long as you can justify, you really need the money, for your business, and you're using it within the spirit of just, helping the economy.
Okay. When are we going to know more information about that? If that application is going to be available?
Say again? Oh, the application? I don't think they have the application yet. Just watch your email. I think by the time your first payment is due, which is 12 months after you get the money. So that's, probably April sometime. I think you will receive email. At that time, we'll deal with it. But for now, I think it's good to proactively plan it, smart way. Try to use it, have a good trail and good document saying that, the money are used for business.
Sounds good.
Yeah. Good questions. Any more questions, comments?
This is excellent, Jin Hong.
Thank you, Sanjay.
Good information. Thank you.
Yeah, Sanjay, you should book a time on my website. We should talk.
Yeah, we need to.
Yeah.
Well, I've done some cleanup myself,
Okay.
but we should definitely. All your training is out.
Yes.
But it's in a good place now to.
Yeah.
And I want to give you some updates, so I'll book some time.
Sure.
There's a lot of stuff going on.
Yeah. Thank you, Sanjay.
Thank you, Jin Hong.
Thank you, Alma.
Thank you, Jin.
Yeah, thank you. I'll head out
Thank
as
you.
you need. If you need to leave this meeting. Thank you for participating.
Thank you, guys. Thank you, everybody.
Yeah.
Thank you. Bye-bye.
Thank you.
Thank you.